Welcome to the Rural Classroom Plus. This is Steve Barton, and thank you for tuning in. We'll be taking your questions and asking Rick himself. If you're watching on YouTube, Twitter, or any other outlet, we'll be pulling the questions from the Rural Classroom Plus, so head over there using the links down below or go to ruralclassroom.com. Rick, how are you, sir?
I'm fine, Steve. Thank you very much, and thank you for your ongoing participation in this series.
You're welcome, sir. It is my honor to do so. Do you have any opening thoughts for us today?
As it ends up, I do. There's a few things I'd like to talk about. The first thing I'd like to talk about is to remind the people who are attending this session, who attended the Natural Resources Investment Symposium in Boca Raton, that as a consequence of your attendance, either live or live stream, you have access to the tapes, the recordings of the conference. That's a very valuable benefit. I'm absolutely certain, no matter how studious you are, that during the 4 days of the conference that you were not able to properly absorb the 55 hours of content that we gave you. The consequence of that is that reviewing the material, reviewing the tapes, is an absolutely vital part of you getting your money's worth. So I would urge those of you who haven't yet reviewed the tapes, which I know to be the vast majority of you, to do so. I would tell people who were not able to attend either live or live stream that whether you were able to attend or not, the tapes are very valuable. They are available for purchase. And if for any reason, having purchased them, you don't think that you received your money's worth, email us and we will return your money. This is one of the few financial transactions in your life that's absolutely riskless to you. So whether or not you attended the conference live or live stream, in fact, whether or not you attended the conference, the tapes are an extraordinarily valuable resource. Note that they're meant to be used in conjunction with the lessons in the Rural Classroom, in particular, Introduction to Natural Resource Investing, which is free to all of you. Given that it's free, I'll extend the money back guarantee to that too. If for any reason you don't think you got your money's worth from a free service, I will cheerfully refund that which you have invested. Opening note 2. Some of you may know that on Monday of this week, the federal regulators, the Federal Reserve, the FDIC, and the Office of the Comptroller of Currency approved the business plan for Battle Bank, which means that we've passed the last regulatory hurdle that we had in front of us, which means that Battle Bank fairly shortly will be open for business in a limited sense. Understand that a startup bank gets a few things wrong. So we're going to break ourselves in with our own money. The systems will be tested by the employees and the shareholders with their own accounts. After that, we will open the bank to our wait list. We probably won't be able to take business from the general public for as much as a year, given that the wait list of customers waiting to do business with us now exceeds 18,000 people. But if you are interested in receiving interest on your deposits, unlike other banks, check out Battle Bank. If you think during a period of currency turmoil that there's a reason to save in currencies outside the US dollar in a federally insured product, consider Battle Bank. If you'd like your own IRA to be able to invest in duplexes or triplexes or franchises that you control, if you'd like your solo 401k to invest in private credit or private equity without the president say so, just according to your say so, check out Battle Bank. If you are a holder of physical gold and silver, and I pray that you are, and you'd like to access credit based on the value of your holdings, check out Battle Bank. Once again, for many of you who are on the wait list, thank you for your patience. For those of you who'd like to avail yourselves of our services in the first year, get on the wait list. It's likely to be the only way you're going to be able to do business with us for a year. Finally, this bank will grow very, very, very rapidly. Our prior bank, Everbank, grew from 0 to $28 billion. The day it opened, it had no wait list. We start life with 18,000 on the wait list. So I suspect that this bank will grow very rapidly, which will require capital. To the extent that you're an accredited investor and you would like a relationship with Battle Bank that's deeper than being a depositor and deeper than being a borrower, you might want to consider being an owner. Go to battlebank.com, click the tab Invest in Us, and get the information. This offer is, of course, made only by offering memorandum. But for those of you who are interested in investing in what would seem to be a highly promising bank, note, by the way, that I am at present the largest shareholder, so there's conflicts of interest in that. Check out battlebank.com. Check out the wait list. Check out, if you're accredited and you'd like to consider being a shareholder, the Invest in Us tab. Now, let's move on. I think one thing that all of us who are interested, particularly in the precious metals trade, but also collaterally in the industrial materials trade, need to look at is what the Fed decides to do with regards to a rate cut. I would suggest that the market anticipates there's going to be a rate cut. And in the immediate aftermath of a rate cut, I would suspect that the result has already been priced in to markets. But in the longer term, and by longer term, I don't mean much, I mean 90 days, a real rate cut or a series of small rate cuts would signal to savers around the world that U.S. society had lost interest in maintaining the integrity of the U.S. dollar. If that occurs, my suspicion is it looks like the latter part of 1975, which is to say game on for the anti-dollar pro-gold trade. So pay real attention to the interest rate. If the interest rate gets cut and you don't see an immediate response in gold, understand that this has been one of the most widely telegraphed moves in history. The anti-dollar trade, in the absence of a rate cut, is a very crowded trade. There isn't much nervousness in the market. The VIX, as Steve and I talked about on his show last week, the chart looks like the electrocardiogram of a corpse. So in the absence of a rate cut, the anti-dollar trade is a very crowded trade. The incidence of a rate cut might not yield immediate gratification to gold traders because the trade has been so broadly signaled. But over time, make no mistake, a rate cut in the context of a market of the type that we're enjoying would signal to the world that the U.S. is politicized and no longer interested in maintaining the integrity of the U.S. dollar, which sadly for us is very, very, very good for gold. Finally, I note that we have been seeing some really spectacular exploration results from companies that were at the Natural Resources Investment Symposium a while ago. Today's results and yesterday's results from Magna Mining would be an example. These grades are as good as anything that has ever been delivered from Sudbury, and Sudbury is one of the greatest concentrations of mineral wealth on the planet. I'm not trying to say that these grades are indicative of ongoing success. What I am saying is that if Magna, as an example, is able to continue doing this, that there's a lot of room left in the stock. And I see very, very, very little mention in the Rural Classroom, as an example, about the exploration results being generated by Vizsla, being generated by Abra, being generated by Montage, being generated by Magna Mining. Pay attention to the news. We have hand-selected a group of companies for you that we think are substantially better than the rest. All we can do is drag you to water. It's up to you to drink. And drinking from the news releases, drinking from these exploration results and trying to put them in context, in particular, putting them in context and discussion groups at the Rural Classroom, comparing your notes with others, is the way that you get ahead in this game. Steve, I think that's it for now. I'm willing to entertain questions.
Okay. All right. So watch the Symposium replays. I'm guilty of that. I need to go through those. Battle Bank is open for business. So again, congratulations. That is awesome. Anyone that is interested, get on the waiting list or go to battlebank.com, click on the Invest in Us tab. And keep an eye on the Fed. The Fed rate cuts, if we see a real rate cut, and I assume you mean by that like a couple percent or something initially.
Half a percent would be dramatic.
Oh, okay. 0.5% would be dramatic, or
dramatic.
A series of small cuts.
Yep.
Then that is going to be game on for our precious metals bets, and bad for the dollar. It'll probably be something of a repeat of the 1975 to 1980 era. And pay attention to exploration results, particularly from Abra, Vizsla, Magna, and Montage.
Correct. I would say with regards to the rate cut, the impact might not be immediate because this has been a widely telegraphed trade. But make no mistake, if there's a substantial rate cut, there will be a follow-through in the U.S. dollar and in gold.
Okay. Yeah, I got the CME Fed Watch tool pulled up right now. And for September 17th, their next meeting, 87.2% of traders think that they're going to cut. So
likely yes. Priced in.
Priced in, yes. I think those guys are some of the smartest people on the planet. And if that's what they think, that's probably what's going to happen. Okay. Oh, what is the minimum investment for Battle Bank if you want to?
First of all, you must be an accredited investor. You have to have a portfolio worth in excess of $1 million. The minimum investment is $75,000 US. Okay,
$75K. All right, on to questions. This is from Rahul. He says, let's see. Okay, the company that was previously Power Nickel. He says, what do you think of Power Metallic and their continuous comparisons to Voisey's Bay and other mega mines?
I like some of the grades that have been that have shown up at Power Metallic. I think it's much too early to compare it to previous discoveries, particularly discoveries of the tenement of Voisey's Bay. I like the people behind it. I like the company, but you're pretty early on.
Okay. All right, he's got a follow-up on Ridgeline Minerals. They seem good at spending other people's money, but they have increased their share count from 30 million to 140 million in the past 5 years, and they haven't actually found anything. What are your thoughts?
I'm not concerned over the fact that they haven't found anything. The process of discovery takes a long time. You invest in prospect generators because they use other people's money to do that. The fact that they have expanded the share count so dramatically is, in fact, troubling to me. You judge prospect generators by the amount of third-party expenditure that you attract relative to your carried interest, relative to the amount of money that you spent on G&A, attracting the third-party expenditures. The share count increases at Ridgeline suggests that internal efficiency, which is to say the amount of third-party expenditure generated relative to the general and administrative expense that would have led to that dilution, is bad relative to their peers.
Okay. Brian wants to know. He's asking about optionality. Can you give us a 101 on what you mean when you say optionality?
Optionality is a phrase that folks like me use to describe companies that offer a lot of leverage to the metals price. These typically come in the form of very large but low-grade deposits that say would not be economic at $3,000 gold, but could be wildly economic at $5,000 gold. Pre-1992, in the period 1985 to 1992, at least that 7-year period, the industry was coming off that ugly hangover in the early part of the decade of the 80s, and it was assumed that commodity prices would never go up. So deposits that didn't have a net present value at then existing commodity prices were priced in the market at zero. There was no sense that metals prices would go up. A group of us, the people who did Vista Gold, the people who did Silver Standard, Pan American, Lumina, decided that there was an absolute probability that metals prices would go up. And if we could buy out of the money deposits very cheaply, relative to the amount of money that had been spent discovering them or repeating them, and then warehouse them, that would be a good strategy. The idea was that there was no particular point in putting a deposit into production during periods of low metal prices, because when the metal prices rose, you would merely have a hole in the ground where your metal used to be. And in the decade of the 90s, optionality made just ungodly amounts of money. Some of it for me, which was a lovely circumstance. What's changed with optionality is that it became a crowded trade. The success of Lumina, going from 50 cents to $160, Pan American going from 50 cents to $45, Vista in the day going from 50 cents to $12 or $15, and spinning off Allied Nevada, which itself went to $40. The success of the optionality trade meant that it became a popular and then crowded space. There is still room for optionality plays, but I want to say that there was more optionality in Silver Standard with a $2 million market cap than there is in some optionality plays today with a starting market cap of $1 billion. Getting a 45-fold run from $1 billion is arithmetically a very, very, very tough exercise. So yes, the theme still has merit. Ironically, the theme is more popular now than it was in the early 1990s when it was free to participate. So buyer beware.
Okay. Would you say Endeavor Silver is like an optionality play today?
Endeavor Silver is a different kind of optionality play. Endeavor is a producer. They're an inefficient producer. They're a high-cost producer relative to the median. And what that means is that if the selling price of the product goes up, their earnings ironically increase faster than the earnings increase that occurs in a more efficient producer. That's a different form of optionality and probably a safer form of optionality. It isn't a form of optionality that likely gives you a 10 to 1 or 20 to 1, but it is a form of optionality that occurs much more quickly. There likely is a new kind of optionality that will come into the market. And that is to say, by the way, with a higher probability of success, but with a lower payoff. That is the fact that there's going to be capital cost optionality. Companies that have existing paid for infrastructure with long lives don't have to repeat that infrastructure. And I think we're in for a period, at least a 5-year period, where estimates of the upfront capital cost to build mines are going to be wildly understated. In my discussion at our conference with Amar Al-Jundi, the CEO of Agnico Eagle, a formidable mine builder, he is suggesting that, at least unconstrained, the input costs around building new mines is going up at 10 or 12% compounded,
Oh, wow.
which suggests that today's billion-dollar mine is 2030's $2 billion mine. The optionality here I'm talking about is the fact that many people don't pay enough attention to the value of in-ground expenditures that don't need to be repeated at inflated dollar, numbers. Many people are willing to pay market capitalizations based on undeveloped deposits that will be developed 5 or 6 years from now, based on capital cost estimates that are done in constant dollars, not in nominal dollars. And that's a mistake. And I suggest, therefore, that people are likely underpaying for high quality incumbents with very long reserve lives.
Yeah. Okay. Okay. And let's see. We got one other one in the queue here. Victor wants to know, could you share your current thinking on coal stocks? What are any specific comments on core natural resources or thoughts in coal in general?
Thoughts on coal in general. My difficulty is that the lowest cost, highest volume coal producers are companies where their financial results aren't dominated by coal, which is to say they're indirect plays. So the best coal mining companies are the great big major mining companies, which produce a lot of things. The plays that are focused on coal tend to inhabit the wrong part of the return on capital employed curve and the all-in sustaining cost curve. I suspect that coal stocks are cheap. I think that coal stocks are valued as though demand for coal was going to go away. The largest year on record for coal demand was 2024. And the amount of new project and sustaining capital investment that the coal business is seeing is negligible, which suggests that the industry's producing capacity will fall. So the incumbent producers that are making sustaining capital investments will likely enjoy much better pricing 2 or 3 years from now than the market thinks. The second thing about coal that people need to take into account is that these things have very, very, very long reserve lives. Analysts like myself value them on a discounted cash flow basis, which means really any cash flow that occurs after year 8 or 9 has no net present value. The problem with that assumption is that at year 8 or 9, you run a new net present value calculation, you take it all the way back to 100. So the tail in net present value calculations has to be, from an accounting standpoint, much fatter for these 20-year and 30-year and 40-year long reserve lives. And you see that consistently in the coal business.
Okay. All righty. Richard wants to know, he says, appreciate your comments on Pan America's purchase of Mag Silver. Is this a hang on to Pan American or sell?
No, I think they paid a fair price, but I think they got a great deposit, and they got a great deposit with lots of exploration upside. They paid a fair price for a great asset because they bought a minority interest. And most companies don't want minority interest. Their joint venture partner, Fresnillo, very tough guys. They tried to do a take under. But they bought such a high quality deposit, and a deposit with lots of exploration upside towards the heat source, which is to the southwest, and also for on echelon structures. I think Pan American continues to go from strength to strength. The downside in Pan American, I think, has to do with the depth of community opposition to the restart of their Guatemalan assets. They have half a billion high-grade ounces in Guatemala with the mine already developed. The anti-mining NGOs in northeastern Guatemala have been successful in mobilizing not the immediate community, but rather the distal community around that mine against the mine. And while I had been led by people I know in Guatemala to believe that we would see political support for a restart in 2025, I am now much more leery about that. I continue to hold hope that the current political popularity of President Milei in Argentina will cause state opposition to the silver project in Argentina, which is a different 500 million ounce deposit, to evaporate. And I continue to hope, at least, that we see positive news out of Argentina in the next 12 months. Understand that neither the Argentine asset nor the Guatemalan asset contribute meaningfully to the market capitalization of Pan American. These are both icing on the cake.
Yeah. Navidad down in. Okay. Han wants to know. Hi, Rick. Western Copper currently has a market cap of around 286 million, while the initial capex required to build its project is approximately 2.7 billion. Based on your past experience, when a company's market cap is much smaller than its required capex, what key factors or checklist items need to be in place for the project to have a realistic chance of being successfully developed?
First of all, the financial services community and the mining community needs to believe that the upfront capital cost estimate are reliable. That capital cost estimate is several years old. I've been to Casino. I've been to their project in the Yukon. And this one is infrastructure challenged. It would also depend. High upfront capital costs are achievable if the return on capital employed is high. But if the return on capital employed is meaningfully below 25%, the ability to finance a project that's substantially in excess of the market cap of the issuer becomes suspect. The third aspect would be the all-in sustaining cost, where the deposit fit on the cost curve globally. If this would be accretive to a major mining company, which suggests that the all-in sustaining costs would be in the best quartile worldwide, often rather than build the deposit, what happens is that the company itself gets bought by a bigger company who can build it. In the case of Casino, that isn't the case. A combination of concerns for the reliability of the capital cost estimate, the estimated return on capital employed at current copper prices, and its position on the cost curve cast some doubt as to when it would become economic. It's worth noting that one of the world's largest mining companies, Rio Tinto, has a shareholding and likes. Well, I don't know if they like it or not, but they do have a shareholding. I suspect that's because the exploration upside there is still substantial. I don't like the grade. I don't like the location. I don't like the capital cost. I like the fact that Rio's in place, and I love the exploration upside around the project. I do not own Western Copper and Gold.
Okay. Do you have a ranking?
I don't know if I do, and if I do, I don't remember it.
Okay. Hi, Rick and Steve. Question for Rick. Any thoughts on Lotus Resources and Malawi as an emerging mining jurisdiction?
Malawi is an interesting jurisdiction. I'm involved there in a different company, Sovereign. And I need to say, one of the challenges in Malawi is not ill will with regards to the government, but rather lack of capacity. It's very difficult for them to regulate an industry that they don't understand. That part of Malawi needs a cash economy in the worst way. They would really, truly benefit from this. And that was originally a fairly well-engineered project in terms of groundwater safety and everything else. My suspicion is, given indications of goodwill from the government, that this gets built. But there are risks that the government will delay decisions around topics that they really don't have the internal capability of understanding. And that describes Malawi. Not ill will, I think, in fact, goodwill. It's just that this country doesn't have a tradition of mining. The infrastructure constraints were ameliorated by the last operator, Paladin. Originally, This was a project that was transportation constrained, power constrained, and water constrained. That's no longer true. It was built. It needs to be restarted now. Probably access and egress, which is to say the roads have deteriorated. This is, after all, rural Africa. So probably that's going to have to be rehabilitated. But this is a nice deposit. A lot of it's known. And I think, to repeat myself, the interaction between the mining community and the two companies specifically and the government are what are going to be required to make this work, addressing somehow the issue of government capacity. The original mine partly came to be because the then operator, Paladin, actually assisted the government of Malawi in conjunction with a law firm in Great Britain in drafting their legal code and their fiscal code, tax code with regards to mining. They had to be assisted. They had so little experience in this, lots of experience in other places, and by the way, very goodwill at that point in time. But the development of the project included the development of a government capacity to regulate the project.
Okay. Josh wants to know, what are Rick's thoughts and ranking for Oceanic Iron Ore Corporation?
Interesting question. I have Oceanic at a 5. It doesn't fit in the lowest cost curve worldwide in terms of seaborne iron, but the potential concentrate that it would make, or the pellets that it would make, are of very high quality and would be useful for blending with Pilbara product from Australia to generate a higher quality steel. The project is on tidewater. Admittedly, that tidewater is in Santa Claus side yard on the eastern seaboard of Canada, painfully close to the Arctic. I don't own Oceanic, but I'm looking very carefully at becoming an owner, particularly if we see continued weakness in the iron price. This is something that will likely take a while to give us joy. And if it takes a while, I want to be able to buy it at a substantial discount. It is very well held. Stephen Dean, who is can't describe him any other way, the genius behind Artemis, and Frank Justra, who was on my Investing Legends panel at the conference, are the two largest shareholders. So if you look at the stock, the float relative to the market cap is very small, and the control position is large and in the possession of two very smart guys. Have it as a 5. I'm looking to move it to a 4.
Okay. Okay. David wants to know, do you think G2 Goldfields is cheap? What ranking do you give it?
I don't think it's cheap, but I don't think it's expensive either. It's a high quality project. The company has done a good job of marketing themselves, and the company's done a very good job of attracting a strategic toehold shareholder that will prevent a take under by their neighbor, G Mining, who I own a lot of. Note that I own some G2. I continue to hope that the people at G2 and the people at G Mining can overcome a historic enmity and work together so that they can build that deposit together. Well, I don't think it's cheap. I don't think it's painfully expensive to participate in a 10 million ounce deposit either. The underground grades are, from my point of view, a bit skinny. And they haven't, as of yet, found a place where the deposit blew out into well-prepared rock for a very large open pit, the way G Mining has done to the immediate south. The fact that their deposit, G2's deposit, is almost certainly related to the G Mining deposit, the same sort of geological event, tells me that there's a lot more gold to find on the G2 side. And I think they're doing a pretty good job of doing exactly that.
Okay. And Chris wants to know about Next Metals, Frank Justra's latest endeavor, and the Celebi/Selkirk deposits in Botswana.
Nice deposit. And what Frank did is become his hallmark in the last few years, which is to take a good deposit that was financially troubled, had new management and new money, and make it untroubled. I had two problems with the former issuer. The first was that the management team, let's just say, lost the plot. Couldn't raise money in the correct way, so they raised it in an incorrect way, and the balance sheet was just pooched. Because of that, the previous management team was never able to make what was a nice small deposit into a nice medium size or a nice large deposit. And as you know, Steve, I have a prejudice against small mines. What Frank's team has done is they've added some capital to the mix, and they've absolutely started drilling this thing off. And the recent drill results there have been very, very, very good, albeit from a fairly constrained, fairly small base. This is what I'm looking at. It's currently unranked.
Okay. Z-Sold wants to know, he's asking about oil and gas. And he says, oil and gas drilling and rental equipment companies are pretty hated. The likes of Patterson, Novink, Precision Drilling, Helmerich, and Payne. What are your thoughts?
I'm a Helmerich and Payne owner, so let's get that one out of the way. Very conservative balance sheet, a company that does a very good job selling off their old capital equipment and booms, which is to say, in very good markets, they sell their 7 or 8 year old rigs to upstarts and reinvest the money in new equipment. It's an absolutely premier land driller, with the exception of names like Schlumberger and Halliburton, the highest quality names. I haven't impressed myself with my acumen in the oil field service sector, so I'm nervous about burdening our listeners with my own opinions to the sector, given that I don't have very much respect for my opinion. A very smart investor who I know, who I won't name, a good generalist investor, but also a very good oil and gas investor, has suggested that given my sustaining capital thesis, which is to say that the oil industry has underinvested in sustaining capital for a long time, that the oil service sector is probably the most leveraged of all the resource sectors. I will repeat that not as my gospel, but rather as someone who has had more success as an oil field service investor than I, as his supposition, not mine. I own Helmerich and Payne, I own Schlumberger, and I own Halliburton.
Huh. The most leveraged?
That's what he says. Yeah.
Okay.
You know, their results are very, very leveraged to the rig count.
Yeah.
As you get equipment tightness, you get day rates and footage rates that go up fairly rapidly. And in a business like that, when you cover your fixed costs, your marginal revenues have very, very, very high profit margins attached to them.
Yeah. So would this bet be kind of like maybe a little bit later in the cycle when we start ramping up more drilling rigs instead of shutting them down? And
yeah, correct.
Okay.
Correct.
Okay. I've purposely been holding off because of that. Maybe, I don't know. What do you think?
I've been holding off simply because I haven't been competitive in the sector in the past.
Okay. All right.
You know, to me, my impediment is me, not the sector.
Okay. All right. Okay. Let's see. Let's get someone that hasn't asked one. Alan, Rick, the best of the best rule. Any comments on the results of Marimaca Copper's feasibility study this week?
I thought it was spectacular. The return on capital employed exceeded my expectations. I haven't been able to do the comparative work. One of the things I often do is I use the capital cost assumptions, and I call up people who have built similar projects and say, what do you think about this? Does this mine get built for this price? And often I've had people come back to me and say, you know, those assumptions are daft. But I haven't done that with Marimaca yet. Obviously, by the way, I'm not the only one who liked those results. The stock gapped up. It was a good document.
Okay. Let's see. Frank says a lot of NL writers, it must be newsletter writers and pundits, are saying that a depression is on its way. What's your take on that?
not smart enough to know. I'm not an economist. I'm cognizant of the fact that we haven't had a proper recession, if there is such a thing, for 15 years. And I'm not sure that we have rewritten economics or economic history. Periodicity does not cause recessions. I'm concerned about the impact of the global economy that stems from geopolitics and trade wars. We're richer when we trade with each other, and poorer when we don't. I'm concerned too about government debt and deficits on a worldwide basis, but particularly concerned about government debt and deficits in the countries that eat, the consuming countries, Western Europe, the United States, Canada, Japan. That's problematic to me. I'm concerned about the level of government debt relative to private savings, except for in China, where private savings are very high. The consequence of that is that a recession wouldn't surprise me. Part of me says that the weakness that you see in seaborne natural gas and oil prices, in the face of constraints like Russia's war, would tell you that we're already in the early stages of a recession, which is to say, it's not in the out months, it's in the current months, which arguably is why demand for BTUs on a global basis is so soft. But I'm not smart enough to tell you that.
Okay. Guillermo wants to know a question with regards to valuations. What free cash flow multiples does Rick consider cheap, overvalued, or fair for producing companies? Does
I,
this change? Oh, go ahead.
I don't use free cash flow except as a component of debt service. I use net present value. The reason for that is that free cash flow doesn't take into account whether it's a deposit with a short life or a long life.
Mm.
I would rather have median free cash flow in a 30-year deposit than very high free cash flow in a 3-year deposit. While the market utilizes free cash flow, I think that's because we all learned from the same textbooks, and we learned to analyze cash flows when we were analyzing companies like bakeries, where you didn't have reserve life considerations, where you had a plant and milk and flour and sugar and salt came in the front side and bread went out the backside for a very long time. With a mine, your bakery has a fixed life. And so free cash flow is a less important consideration than net present value, except that net present value doesn't service debt. Cash flow does. So you need to employ both metrics. Cash flow to measure your downside, net present value to measure your upside.
Net present value, upside, cash flow downside. Okay, Zahara wants to know, Rick mentioned strategic metals in his previous live stream in the Yukon. Could he please share some insights on the company and his team, and how do they compare with other prospect generators?
Well, let's say first of all that mention came in questions about mining companies in the Yukon, and Strategic is far and away the smallest company in that discussion. So comparing them with larger proven deposits is comparing grapes and watermelons. Strategic is a prospect generator. I know the company quite well. I wrote a Save the Company check in 1991. The management team is the consulting group from Archer Cathro, who knows more about exploration in the Yukon than their closest competitors, although one could argue that some of their closest competitors, the Snowline guys, have been more successful despite the lack of encyclopedic knowledge. They are a company that stood the test of time. They are occasionally a recidivist prospect generator, which is to say, when their market capitalization allows them to raise enough money to drill their own projects as opposed to raise third-party capital, they do that. So let's get that part straight. I think the time for Strategic is coming. I remember back in, I think it was 1990, we wrote checks for 3 little Archer Cathro companies. We called them in derogatory fashion the 3 pigs. Strategic, Attack, and I forget what the third one was. One of those, I mean, Strategic did well. I think we wrote the check at 10 cents or 12 cents, and the stock went to $3.50. But Attack went from 10 cents to $10. It was an extraordinary move. I need to say that the last $7 of that move occurred without me, but it says something about buying shares in prospect generators with narrow share counts that don't have to dilute and enjoy good exploration news. When the money comes into these things, they're very small share count, and their efficient capital structure means that the gains that you enjoy in these things are spectacular.
Okay. Digging for Alpha says, hi, Rick and Steve. What are your thoughts on Paladin's latest PLS project economics update with the about 50% increase in initial CapEx up to 1.2 billion? Do you think NextGen's project could face similar cost pressures?
Guaranteed. Absolutely positively guaranteed. I had a really, as I said earlier, eye-opening interview with Amar Al-Jundi from Agnico Eagle, a first-class mine builder, who told me that everybody needs to understand that the input costs around construction are increasing at 10 or 12% compounded. If you are relying on capital cost estimates that are 5 years old, do the math. Do the math.
Okay. All right. Han wants to know, what's your opinion on oil production from Denver, Julesburg Basin? Is this a great basin to explore and produce oil?
The DJ Basin is a good basin. For those who don't know, not surprisingly, the Denver-Julesburg Basin is located mostly to the north of Denver, Colorado, Adams, Weld, those counties. An old producing province, one that I had a lot of experience in the 1970s. It's underlain by the Niobrara Shale, which is itself a good generator of oil and gas. But in addition to that, has proven to be, at least in certain sections, a good primary target for horizontal drilling and multi-stage fracturing. The basin has a lot of life left. I suspect that the remaining reserve life in the basin is too small for the big companies. And I suspect what you'll see is that the big companies will divest their holdings in the basin to smaller oil and gas private equity groups and family offices. But there's an awful lot of room left in the basin. When you go down the drill stem there, if you drill down to the Niobrara, it's not uncommon to have 7 or 8 shots at having an economic completion. It's sort of a layer cake of sedimentary horizons with porosity that are really ubiquitously charged with oil and gas.
Okay. Tillman wants to know, he's asking about Newmont and Agnico Eagle. Newmont announced the want to lower all-in sustaining costs and fire people. And Interactive Brokers for the last quarter, I get Agnico cash per share $9 and Newmont cash $6 per share. Do you see this difference to continue in the favor for Agnico? Would you think Newmont could increase their cash per share even if they won't get the same?
I think that Newmont will increase their cash per share. What you've seen Newmont do is sell all of their or almost all of their second tier assets and turn them into cash. They had budgeted raising 2.2 billion in cash, and they're at 4 billion and counting. In addition to the fact that they've added $4 billion in cash, what they have done is they have reduced greatly their need for sustaining capital reinvestment. I think it's arguable, I'm being polite, that over the last 5 years, Newmont has looked at their second tier assets as sources of cash, and they've deferred sustaining capital investments. Had they not sold them, I would suspect that they would have had a very large deferred sustaining capital bill, which they're missing. This is both good and good. Newmont now has looked system-wide and said, since we have reduced the number of mines we operate by 12, and since we've substantially reduced our development pipeline, we have to reduce our headcount. We have a bunch of people here that were employed in a different company, and that company doesn't exist anymore. Some of their all-in sustaining cost pressure is beyond their control, or at least their direct control, which is to say their most important remaining producing asset is their minority interest in northern Nevada gold mines, where they are partners, but a minority partner with Barrick, and reducing all-in sustaining costs in Nevada will require a joint effort with Barrick. Those operations, as far as I know, have not suffered from a deferral of sustaining capital investments. Both Barrick and Newmont have been pretty good, as I understand it, at maintaining the infrastructure in good order. What you need to be nervous about with major mining companies when they talk about a really dramatic decrease in all-in sustaining costs is that they achieve that by high grading, that they achieve that by picking the high grade eyes out of their deposits. And by reporting that on a unit of production basis, rather than accounting for it properly. When you see companies where for a quarter, the average mine grade in the quarter is substantially higher than the median reserve grade that they report in their reserve reports, what that means is that they're high grading. It makes that quarter and the next quarter and the quarter after that look very good, but it sterilizes the rest of the deposit. Ultimately, in the out quarters, they have to mine material that's less than average grade, and when that happens, their all-in sustaining costs skyrocket. So, what will be important with Newmont will be better disclosure on precisely how they expect to lower the AISC cost.
Okay, you're saying if they're cherry picking these deposits and pulling out the best stuff first, they're going to have amazing blowout quarters, but then after that, all the low grade stuff is going to
exactly right
in the numbers. Okay,
exactly right.
Sure, that has been done many times before,
including by Newmont.
Okay. Okay. Antia says, "Hi, Rick and Steve. What are your thoughts on Scotty Resources? Do you have a ranking, and are you a shareholder?"
I'm not a shareholder of Scotty, and I have it as a 6. I see it as an interesting deposit. I remember when it was a mine, but I see it as a decidedly tier 2 deposit.
Okay. Cohen wants to know, he says, "Hi, Rick, is there any chance that a separate session with David Wargo on rare earths could be organized?"
Yes, I'm more and more interested in rare earths. And as I've dug deeper into rare earths, I've run into more and more people who have stuff to share. A geologist who I used to know very well, Keith Laskowski, is doing a really deep dive, a decade-long deep dive into rare earths. There's a very, very, very smart guy, Clint Cox, something like that, who we should use. And then digging way back into my past, there's a very high quality but almost unknown newsletter writer named John Kaiser, who has done deep dives into rare earths. And so I'm considering doing some type of online rare earth session, not necessarily around a specific company, but rather one that would increase the knowledge of the real classroom community around rare earths, and also facilitate discussion between these unknown experts and people who are interested in the topic. I'm fascinated by it. And frankly, I'm working very hard at it. The more I come to understand, the more I know that I don't know, which is a scary place to be. What I have been able to do as a consequence of my study in the last 6 months is come across more and more people who know. Dave Wargo, you'll remember, did our last rare earth session. And despite the fact that he's known now as a finance guy, he's a chief executive officer of SCP Capital Partners and somebody I worked with at Sprott. His background is as a metallurgist and process engineer, first for Inco, and then for one of the first rare earth companies in North America, Neo Materials. Much of the Chinese technology, the vaunted Chinese technology around rare earth capture and processing, was originally developed by a Canadian company, Neo Materials, and Dave Wargo and his team, and became the property of the Chinese because they employed all of that technology in China. He's a young guy, but he's sort of a grand old man in rare earths.
Okay. Speaking of rare earths, Richard wants to know, what is the current unanswered question for Meteoric?
Well, the first unanswered question is, can they solve the community problems? These type of problems, by the way, usually are solvable. If you have a $20 billion deposit wrapped up in 100 million market cap, there's usually a way to share the pie. And it's interesting that the community problems seem to be caused by a counselor who was committed to vote in favor of it and was convinced overnight to vote in opposition. One would suspect that a local politician who's that flexible might be convinced to change his mind again. I'm hoping, by the way, in 2026 to visit that deposit. I have now 4 investments within a 150-kilometer radius of that deposit, and it makes absolute sense that I'd take myself and the ever-loving, beautiful Mrs. Rule down to Minas Gerais and look at the Centaurists and the Meteorics and the Bravos of the world, which I'm looking forward to doing.
Yeah, that would be cool. Let's see. Mike wants to know your thoughts on Salazar Resources.
I'm a Salazar shareholder, and I'm a huge fan of Freddie Salazar. I'll admit he's an acquired taste, a strange guy, but I've acquired him. Salazar is a prospect generator come mine developer in Ecuador. Ecuador is a ferociously tough jurisdiction. Freddie Salazar is from there, and I would suggest he has a better handle on both the politics and the sociology of Ecuador. And he has a 30-year experience with regards to the geology of Ecuador. If somebody parachutes in from Reno and goes head to head with Freddie in Ecuador, they're going to have a tough time. Most of the stuff that the new guy looks at and gets excited about, mostly those are rock packages that Freddie already cracked. So yeah, I'm a Salazar shareholder. Lots could go wrong. That's a culture very much in transition. The current government is pro-mining, but the current government is hanging by a thread. There is lots of active NGOs in the country who are anti-development, anti-mining, including Oxfam, that famous British group that campaigns in favor of famine. So there are challenges around it. But yes, I own Salazar.
Okay, we're getting close here. Hunter has an asked question. What platforms do you use to check equity prices and place orders?
The platform I use to place orders is the telephone. I maintain most of my speculative precious metals, or mining accounts, with Sprott Private Wealth.
Okay.
Platform I use is I call my broker, Eric Angeli, and I say, hey, Eric, I want you to buy X number of shares of XYZ. I want you to use your discretion, or I want you to be aggressive, or I want you to hang back in the weeds. To the extent I don't use that, I use Interactive Brokers.
Okay.
Interactive Brokers, by the way, is a wonderful platform for trading stocks worldwide. If you are technologically challenged, which, Steve, as you know, I am, Interactive Brokers is occasionally clunky. And I have to say the customer service keeps me sullen, but not yet mutinous. So use it at your own risk if you are like me, a Luddite. If you're in your 20s or 30s, and you can make your telephone shine your shoes, you're not going to have any problem with Interactive Brokers.
Yeah, I found the same thing. The customer service is hit or miss. But the nice thing about Interactive Brokers is it will let you do and convert just about any kind of currency and buy almost anything on the market. So
they're cheap and they're efficient if you are efficient at knowing how to use them, which sadly I am not.
Yeah. Okay, last question from Diane is asking about Contango. Thoughts on Contango?
I no longer own Contango. It did what I hoped it was going to do. They've got into production. They're shipping rock to Kinross. The market didn't completely adopt it, but the market gave me what I wanted. I'm more concerned. I wouldn't say I'm concerned. The management team is very much focused on using the cash flow from the existing producing asset to exploit Lucky Shot. And Lucky Shot seems to me like a fairly small, high-grade occurrence. and I don't think that Lucky Shot will meet my parameters. I'm more excited, and I forget the name of the deposit. There's a deposit they acquired last year. Um, when they acquired High Gold, which would seem to be something that they're looking at 2 or 3 years from now. I sort of wish they would reverse the order of importance there and focus on the High Gold asset as opposed to the Lucky Gold asset. But as I say, this is all academic because I don't own it anymore.
Okay. All righty. As far as next week, some upcoming events in the Rural Classroom Plus, we have Adrian Day, September 3rd at 4 p.m. Pacific time. Then in the Rural Classroom on September 4th, I'll be pulling up charts. So I have been pulling up questions of companies that you want. If you guys want me to focus on something in particular on the charts, maybe put that in comments down below this video and we can do that as well. But that's what we got in the works for next week. What any final thoughts, Rick?
No, I think we give it a pretty good shot. I do want one more time to remind people to review the tapes of the conference. There's a lot of great material there, and you paid for it. You suffered through it once, so you've got a good grounding in it. But there was a stupendous amount of good material there, and I am highly confident that people who were there have forgotten 50 or 60 or 70% of what they paid to learn. And the only way that you can get your money's worth is to apply yourself and relearn it, and then employ those lessons in the context of the rural classroom. This is meant to be an integrated exercise that makes you better investors and speculators in natural resources. That requires your participation. I can't spoon feed you.
All right. We will rewatch the tapes. Thank you very much, Rick. Thank you to everyone for being here. We will see you next week on September 3rd and 4th. You guys have a wonderful rest of the day.